Stocks plunging today and the 10-year yield falling to near 4.4%. Consumer sentiment softening more than expected in fresh data from the University of Michigan survey as economic growth concerns are back in focus. And joining us now is Jefferies chief market strategist and CNBC contributor David Zervos. Happy Friday, David.
Happy Friday.
After Election Day, stocks popped to about these levels. S&P is around 6,000 again. We've been higher, we've been lower. You've been optimistic about the Trump administration's impact on the economy and the markets, but is this level a major test?
I don't know that it's a major test, John. It's early days. There's a lot to chew on. I mean, we've got people are going back and forth on the deregulation policies, on the tariff policies. You've been going through everything this week. We've got a lot of new things to think about, everything from, a possible outbreak in China to what's going on in Ukraine. It's a lot to chew on. I think people have a little bit of indigestion with the stories that are coming through, and it's going to take a while to plow through all that. But I remain steadfast in my optimism. I remain steadfast in my view that the dominant long-term force that this administration brings to markets is a positive supply side story, which is stronger growth, disinflation. Secretary Scott Bessent said it earlier in the week. He said most of these policies or all of these policies are disinflationary in the end. I don't know that all of them are, but the dominant force to me is the disinflationary one. And that just keeps me optimistic on everything from Fed policy to just where interest rates are headed more generally at the long end, and the strengthening that I see in corporate America that comes from the cutting of red tape and the smaller footprint of the government sector.
David, I'm a bit puzzled by the messaging around the Department of Government Efficiency. I mean, I know that the messaging is cost savings, it's rooting out waste, fraud, et cetera. But those of us looking at the big picture know that saving $1 billion here and there, while, $1 billion is $1 billion, it's not significant to the overall fiscal position that the U.S. is in. We've got to address entitlements if we're going to do that. And right now, there's a lot of dust and concern stirring up around these smaller potatoes. Does that give you any pause?
It doesn't. I mean, I just like the direction. I think the market likes the direction that we're just slowing everything down. We're looking at fraud and abuse. We don't know yet. Maybe that's less significant, John. Maybe it's actually something that's more significant. We don't know about these Social Security names that may have been overcounted, or multiple Social Security numbers, or people that hung on the rolls a little too long. All that's up in the air. Let's watch and see. I think it's healthy to go through and look at how the entitlements are delivered. And if there is an issue with how they're delivered, we don't cut entitlements, but we actually have an issue with cutting the cost of delivering the entitlements. Let's see. I think I like the direction we're going in. We're going in a direction of let's sort of step back and take a look at everything and not just sort of go with the status quo. And I think the markets are going to like that. I think we are probably going to find a fair amount of things to cut back. And we may, unfortunately find too many things at one point, and we'll find we went too far. But let's cross that bridge when we get there. Again, I want to stress, I think the market has overemphasized the risks on tariffs and immigration being stagflationary, and probably underemphasized the benefits of a smaller government sector more generally and deregulation.